Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome, ladies and gentlemen. Welcome to Nirmal Bang. A very good morning to all the viewers. I'm Hiral Dadia. We have with us Seth Freeman, MD at B. Riley Advisory Services, formerly known as Glass Ratner. Welcome to the show, Red, and it's Seth, and it's a pleasure to speak to you after a very long time as well. My first question coming to you over here is, with the kind of impact COVID has had on different economies across the globe, we know that no one has been spared so far. However, now the conversation has been that slowly, steadily from here on, it's the revival that should be happening. What's the sense that you hold for different economies right now? And at what stage are we if we have to talk about revival?
Well, I hope we're not talking about survival per se, but we're certainly seeing, different experiences in different countries. But we're also seeing, different cycles in the virus and infection rates and positivity rates. There hasn't been really a totally smooth experience in any country so far. And there's been different approaches. We saw how Sweden approached it. We've seen how France and England UK has approached it. And certainly the United States and India have approached it differently as well. And predictions that were made in terms of how long this would last and how deep it would be have turned out not to be right. And so the hardest part is uncertainty. And I think we're going to be living with this kind of uncertainty for some months now.
Right. So, taking this uncertainty into consideration, if you have to correlate with what's happening with the different economies, there has been a lot of trouble on the healthcare front. GDPs have been contracting. However, markets are just flying. We aren't really seeing any correlation that's coming in between markets as well as growth. What's your thought on this, and what's the reason that you see that we are seeing this kind of an up move coming in with regards to the commodities markets, with regards to equity markets as well?
It's very hard to explain, in a sense, why the US market should be doing as well as it has been, given the numbers of people that have been laid off, changes in consumption patterns, but also, just demand. For example, we are seeing in the United States a tremendous number of oil services companies and companies related to the oil and gas business going bankrupt and cutting back because demand has decreased so much. But equity markets are supposed to be forward-looking. And I guess that means that traders and investors still remain optimistic for the long run. However, it's also important to note that the US market, particularly the indexes, have been quite strongly driven by a relatively small number of technology stocks, especially in the NASDAQ.
Right. So, taking this into consideration, if you see COVID-19, as you mentioned as well, that's something which has actually come ahead and triggered a deep economic crisis. Now, given the magnitude of the potential unemployment that we could see, business failures, or even in the form of, say, financial system risk, probably this could be broader than what we've seen since the Great Depression of the 1930s. And that's what everyone's talking about. Now, this is the time when you have the insolvency systems that actually come ahead with innovative reforms to overcome the impact of the crisis. So, if we have to talk about restructuring, if we have to talk about bankruptcies, and if we have to talk about insolvency, what according to you needs to be done from here?
Well, it's interesting in terms of the US market. not too long ago, and it really wasn't connected to COVID-19 at all, there was an addition to the Chapter 11 process, which is traditionally a restructuring process called Subchapter 5, which is a simplified version for relatively small companies. And whether you can use it or not is based on the size of your debt. And one response by the government to COVID-19 was increasing the maximum amount of debt that you could qualify for this relatively simplified form of Chapter 11. But Chapter 11 is very expensive, and there are other alternatives as well. But many companies, we're looking at companies, same thing in India, frankly. There are obviously companies that at any given time are struggling or not doing well, or their capital structure is messed up, or they're facing unanticipated competition or some other problem that are already weak companies that would find themselves needing to restructure. Because of coronavirus and COVID-19, companies that were fine, operating fine, long established companies with earnings and predictable earnings found themselves having to shut down, having customers go away, losing their employees, and so forth. So there's really kind of two kinds of companies that were in bad shape already, or having problems, and businesses that were in great shape and find themselves affected by this. And actually, many of those operators are having a tough time because they don't have any skills or experience dealing with this kind of crisis.
Right. So if we have to talk about insolvencies, a lot of research reports are indicating that 2021 could bring an avalanche of business insolvencies, once the effects of lockdowns on businesses take hold. And USA probably is expected to see insolvencies which could go up by almost around 55 to 60%. Brazil, UK, and China, these are a few of the other ones which could be hit hard. If this is what is expected, do you think we are really in trouble in terms of the next 3 to 4 years?
Well, various experts are coming out and saying, no, we're not going to have a quick recovery. It's not going to be a V-shaped recovery. And it could take 2 or 3 years for this to work through the system. A lot of it has to do with two things. One is science and technology. Can we get vaccines? Can we get testing? Will people be comfortable to, go back to what we thought was normal? And how long is that going to take? And then the other part is purely emotion and demand for goods. There's I think we're going to see this in India, in the US and Europe, particularly in the US. Quite a number of us are able to work at home. There's a lot of question now about whether so much office space is going to be needed. And so when we think about the effects of COVID-19, we may focus on consumer businesses, but we could have a very serious mortgage-backed securities crisis, not only in the US, but globally, because office buildings, hotels, and so forth are not going to be able to make their debt service.
Right. Another interesting fact that I've been picking up, Seth, is with regards to where the US Bankruptcy Tracker goes. Now, they are seeing filings which have hit pre-virus low on the back of easy money. If you talk about end of August and the beginning of September, there have been fewer Chapter 11s since March after a busy summer. And it's mainly what they're saying is that the cash is flooding into risky debt markets, providing a lifeline. Now, do you think overall cheap funds which are being made available to corporates, to people, that's something which is keeping them afloat right now, but this bubble could burst?
Well, frankly, for a distressed company, there is a lot of money out there. There are many specialized distressed debt funds that exist. There's an ample amount of liquidity available to distressed companies, but I would not say that it's low-cost money. We're working on a number of projects now where what's called debtor in possession financing, are the loans that a company takes out during Chapter 11 to fund their Chapter 11 process. They are in the 12 to 15% range. So for the US, when you look at a 10-year bond rate of 0.66%, 12 to 15 is not cheap. The biggest difference now in the US in particular is that in the past, many borrowers were dealing with banks, and now many borrowers are dealing with hedge funds. And the personalities behind the two different institutions is quite different. And the hedge funds are significantly more aggressive about imposing their security and the putting on constraints and restrictions and making sure everything is leaned up. The situation that you described, where there was a whole bunch of bankruptcies earlier on, it's been kind of slow in relative terms the last 6 or 7 weeks. But there's been some pretty big ones, and many of them have been oil and gas related. There's two things happening. In the US, companies have been able to stay afloat using PPP loans. You may have read about it in India, and also CARES Act loans and financing. And the CARES Act is ending very soon. So companies that had sort of this burst of liquidity to survive on are going to be running out of cash. And as I mentioned, even though they're able to reopen, they can't get enough volume to support their fixed costs. And so they can only last so long. The other thing is the bankruptcy lawyers and advisors are telling their clients there's really no reason to rush for a Chapter 11 unless, let's say, you're about to get kicked out of your office space or your factory by your landlord, because there's no immediate turnaround or a better environment or a better landscape right around the corner. You might as well hold on as long as you can and delay filing Chapter 11. And as a result, I think we're going to see a slew of filings probably in December and particularly in Q1 of 2021.
Right. So with all of this, you have central bankers across, especially in terms of UK, as well as if you talk about the United States, that have been pumping in liquidity.
Mm-hmm.
What do you think, how do you think is that going to impact?
Normally, that would have, an inflationary effect, but we're seeing, central bankers very reluctant to raise interest rates, and Fed Chairman Powell came out and indicated we're going to have sustained low interest rates. The effect of that is lower cost financing, but it also does increase inflation for fixed assets, because the cost of ownership, the cost of borrowing affects prices. And so, it's going to help companies and the economy itself, hopefully recover more easily, but it has to be inflationary. And we're looking at deficits, huge deficits, whether it's in India, the United States, and most countries who are trying to keep their economies going.
Right. So from here on, if you have to look at global markets, what are the factors, according to you, that one should be watching out that could impact markets? Because clearly, the uncertainty of the elections in the US is somewhere started to play out as well.
Mm-hmm. That's a very tough question. We have a lot of dynamics at play between China and the US, the UK and Brexit. um, some uncertainty about how Russia fits into all of this. Um, I still have a very positive approach to the Indian market. Obviously, it's really suffered severely, and certain areas that were supposed to really move India along, like infrastructure, has contracted around 10%. And this is going to just slow down recoveries. But emerging markets tends to have in the past been commodities oriented. Then large consumer economies have developed, but still we're looking from a stock market standpoint. It's still a flow of funds kind of game, and we can see the impacts on foreign currencies and small movements even after SIPs and everything else that has helped stabilize the Indian market. Foreign FPI cash flows will still move the exchange rates.
Right. So overall, Seth, taking this into consideration, as you mentioned, that you're still positive in India, uh, do you think firstly emerging markets could outperform developed markets right now? And secondly, if yes, where would you place India versus the other emerging markets?
Well, I would be surprised if emerging markets were to outperform the U.S. market for some time. And again, it has more to do about money flows and the fact that we're going to continue to need investment here to get our economy up and running again. The other issue is that we just have so much uncertainty, and investors, global investors, except for opportunity type funds, typically back off when times are uncertain. And so I think we're going to see that continuing. Now, the converse to that is simply that the interest rates are so cheap here, and you can get a higher return in emerging markets. And then you're looking at really, what's the cost of insurance on your bets and your long term. And a lot of investors going into India would be concerned about rupee depreciation. And so I think we're going to need to see how things stabilize for a while before there's going to be a big rush into emerging markets.
Right.
And in terms of your question, I think that Asia is still going to be popular. Brazil is not looking very good. Mexico, it's here in North America. In relative terms, it's very interesting. The 10-year Treasury rate in Mexico is very close to India's right now. It's hurting badly. That would be a destination for U.S. investors, because there's a lot of offshoring of U.S. companies in Mexico. But long term, I'm still have a long-term view on India.
Right. So, Seth, overall, now, if you look at valuations as well, it seems India is still expensive at this current point in time. Would you still be a buyer right now?
I think you have to avoid looking at the market, and you have to be pretty sophisticated and look at not only industries but the best companies in those industries. It's very hard though for foreign investors to do that very well. So they really do need to rely on strong domestic fund managers, portfolio managers to guide them. That's really the key problem. Long term, I always like to think about this. I was hoping to find it so I could show your viewers this article I saved from the Wall Street Journal in 2004 when I started following India, and the market had reached 68. The Sensex had hit 6,800 back then. and the headline was that the market's overheating, and we need some time to let it cool off. And obviously, even with the depreciation of the rupee, there's still a pretty decent long-term return. So I think that India has to be looked at in that context.
Right. So going ahead, what asset classes would you recommend at this point in time? Because we are seeing great traction that's happening with regards to silver as well as gold. I mean, the kind of up move that we've seen has been fabulous. Uh,
Mhm.
Again, base metals, some of the base metals have been rallying as well. So what asset class would you recommend if you have to look at commodities, equities, or if for that matter, debt? Where would you place your bets?
Well, I think selectively there's opportunities in equities. Some experts are saying they're expecting to see a stronger movement going into gold. Um, base metals and other metals, copper and so forth. Those generally are reflect, industrial demand and manufacturing demand, and it's hard to say in certain industries where that's heading. I think there are some industries that you know that from a near-term standpoint are badly beaten. So if somebody has the stomach to buy in now, obviously we're looking at autos and aviation and companies that have been really hurt through this. Um, or even frankly hotels. I remember at the beginning of coronavirus, the cruise lines were just decimated, and they've recovered quite a bit. They've been able to place bonds. So it, I think that investors have to be very choosy, and um, I think that an area clearly is in financial services companies and banks. Banks tend to also kind of be good indicators and lead into the future. And I think we're seeing that, even in the market today and yesterday in India. Banks have started to recover quite a bit, even smaller banks or non-bank finance companies. So I would say those kinds of companies. But I think that infrastructure is going to recover more slowly than everyone hoped.
Right. And that we're talking of the Indian markets right now, especially, let's correlate this to what the government has done with regards to the stimulus package. What the
Mhm.
RBI, that's the central bank, has come out and they've, put their one step forward with regards to the loan recast scheme. They have announced restructuring as well, and the rate cut has been pretty stiff. Taking all of these steps that the RBI has taken into consideration, do you think this could bode well and will be a great relief to borrowers and will be able to tackle the stressed assets and the NPA issues in the country? Or do you think the central bank from here on still needs to develop a clear strategy on what to do from here on, to understand that at least it's a smooth sail?
Um, I've been following the India distressed market and NPAs since my very first trip in India in 2004, when Asset Care Enterprises was formed, and we were invited to India to deal with the beginning of asset reconstruction companies. And um, India has had just a pervasive NPA problem for a long time. And the banks have just been so reluctant to mark down loans. The bankruptcy or the insolvency system was just taking hold. It's been going through some evolution over the last 2 or 3 years. I was really, delighted to see the development there. I have a lot of friends in that industry in India. And then when the government put essentially a freeze on using it, um, I think that's a terrible mistake. It's really critical to recycle this capital that's frozen and clean things up. So the government just kind of gives out weird signals where they're fine tuning the insolvency process and then put the brakes on it. Certainly, a lot of companies need a timeout in order to get themselves restructured and to kind of reorient themselves to what could be a completely different kind of environment. But it's very important that RBI put out clear signals on its intention. And it's very hard for businesses, business people and investors to make plans if they don't get clear signals from the government and from the central bank.
Right. And Seth, overall, do you think that the next decade probably is going to be tough for global investors?
The next phase, going into India, you mean, or
Yes,
in general?
going into India, especially.
You know, I think we're going to see a resurgence. We had a lot of private equity investors come into India. First, it was some venture capital investors, then more private equity investors. We're certainly seeing a ton of money being invested by both private equity and venture capital firms and institutional investors in Reliance, Geo and different Reliance companies. I think we're going to see the re-entry of more opportunity funds. We're kind of in what I would call the second generation, maybe even the third generation of understanding India. And a lot of firms have experience through cycles in India. So I think that when we think of global investors, we have to kind of segment them. Are we talking about global, traditional FPIs that invest in equities or debt, or investors that are making more private-oriented investments or buying trying to buy large chunks? I'll tell you, I think one of the biggest concerns I have about RBI's and SEBI's recent pronouncements allowing companies to have as little as a 5% public float, coming out of a restructuring. One of the problems with investing in India in the early 2000s was liquidity. So many stocks just didn't have enough public float to allow institutional investors to invest. And I am concerned that the government is kind of the government was imposing, SEBI was imposing a minimum 25% public float. They didn't do a very good job enforcing that in the first place. And now they're putting out policies allowing companies to go 5%, 10%. I think that's okay. I understand why, to allow the founders, the promoters to feel like they can retain some control. But that doesn't help foreign investors get into the market, because it requires a certain level of liquidity in stock in order to attract investors. And so that's going to hold back the market.
Right. And very lastly, Seth, clearly, where do you see opportunities emerging in India, and which are the sectors, according to you, should be an avoid? Because what's happening is India has always been known as the back office hub right now. Slowly, steadily, you are seeing US, European companies which are looking to switch their manufacturing base from China to India as well. We don't know how easy that process is going to be and how long that's going to take. Taking all of this into consideration, which areas of business would be an avoid for you in India, and which are the sectors which you would say are good bets from a longer term perspective?
Well, I'm pretty good at making some bad calls, so I may be the wrong person to ask. I was still bullish on autos when things were starting to crash, and but you're absolutely right, and it's an important point that from a policy standpoint and a political standpoint, I can see a trend. And I think that, Modi's pretty good at slogans, and some are just slogans, some make some sense. But this idea of Make in India is a good one. And I think there's strong political impetus to try to shift away from China. And to the extent that US companies and other foreign companies become more comfortable opening up plants and so forth in India, that could be fantastic. It could be the most basic kind of manufacturing. India also has very sophisticated capabilities domestically, whether it's not just services, but electronics, certainly medical devices is wide open as an opportunity in India. But a lot of this requires transparency in taxation, taxes, corporate structuring, so that some companies can move their capital in and out. And we've had some problems over the last 15 years with tax cases and so forth. I think that's gotten better, but those kinds of policy issues are very important to long-term foreign investors. But I do think India could be a tremendous beneficiary of a shift away from China.
Absolutely, and there could be great opportunities that could be emerging from here on as well. Thank you so much, Seth, for joining us on the show. It was a pleasure to speak to you. Great insights that we've picked up, and I hope you enjoyed our conversation as well. And we will see you back again soon once we're nearing US elections to understand which way of the street are we headed in terms of markets and the economy. But thank you so much for joining in.
Thanks for having me.